Let's go.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. Investing in private credit really surged following the global financial crisis when banks became hesitant to lend to some corporations. Well, my next guest is an expert in alternatives and private credit and will give us a better understanding or better idea of what this means for financial advisors and the impact private credit can have on investment portfolios. But first, today's episode is sponsored by the award winning Zephyr, which helps investment professionals make more informed investment decisions on behalf of their clients. I am very honored and excited to welcome Miguel Sosa. Miguel is a research and product specialist at Bluerock Capital Markets. Miguel, thank you so much for coming on again. You were on about a year ago or so. I'm glad I didn't scare you away and you wanted to come back on and share some more great insight. It's an honor to have you back. Can you please tell us a little bit more about yourself and Blue Rock?
Sure. Thank you, Ryan. Thank you for that warm introduction. Great to be back on the show. So Bluerock is an alternative investments firm, and really what we focus is on offering differentiated products. And I know it's hard because every firm out there will say that they're differentiated, but we do view ourselves as not only offering those differentiated solutions, but really in more innovative structures.
Okay.
So structures that allow for investors or individual investors to be able to invest directly, to potentially participate in some less liquid or more inaccessible parts of the alternative investment market, and they can do so directly or through their financial advisors. So
Okay.
we were one of the innovators in the real estate space, offering it as an interval fund structure. We continue to seek out and find those innovative solutions for investors.
Fantastic. I'm glad you brought up interval funds. And then we're talking about private credit. Interval funds, I believe a big portion of interval funds are, geared towards private credit. Is that correct? And why so? Why interval funds? Why is that a good match between interval funds and private credit?
It is a good match because ideally an interval fund will invest in a semi-liquid investment class. And
Mhm.
so but that's because the liquidity of interval funds, it can vary. The sponsor can select what the frequency of liquidity is for investors, but most commonly, let's just say for simplistic purposes, that it's once a quarter.
Okay.
And private credit has sufficient liquidity to, if needed, to meet that liquidity request once a quarter. Now, if it were, say, something like private equity, where typically that's in a limited partnership
Yep.
and you acquire a company, that's a multi-year investment. That is not a good fit for interval funds because you don't have the sufficient capital to meet those potential repurchase requests every quarter. But private credit, because number one, it invests or it generates income, and
Yep.
so it's able to potentially generate sufficient income for that liquidity, or there is some trading that goes on in interval funds is a good fit for it. Not quite liquid enough to
Yep.
be in a daily mutual fund, but the interval fund is a sweet spot.
Perfect. Perfect way to start this conversation off. Because I've often, read a lot about interval funds, private credit. So that's a great explanation, Miguel. Thank you. Um, I mentioned at the beginning, great financial crisis, really, that's when we saw a surge in private credit. Outside of that, why is the trade so popular recently, private credit? And is it really driven by the investor side or more from the issuer side? Who's driving this popularity?
It's both, actually, what's happening. So we're seeing this really significant growth, organic growth, because there is growing interest from the investor side with the attractive yields that it generates, because there's less volatility compared to
Okay.
publicly available fixed income. And so investors, especially individual investors, they They like income and they don't like to see fluctuations in their account statements every month or every quarter. And but at the same time, banks have stepped back from lending to companies, but companies still need access to borrowing. And so what banks do now, given the revamping of regulations after the global financial crisis, is that they facilitate the transactions. And so they'll set up a loan, but they don't have that loan on their balance sheet. And so what they do is it's called syndicating the loan,
Yeah.
in which they'll work with the company, they'll set up the terms, they'll set up the documentation, and if they think it's an attractive enough credit for the market, they'll initially loan it out to the company, but then they'll sell off that loan into the market, or they'll sell it to a single sponsor in the case of a smaller credit opportunity. But they don't have it on their balance sheet, so they don't want it on their balance sheet. So that desire to move it off their balance sheet creates the supply of private credit, while at the same time, the demand is increasing because of the factors I spoke about earlier. So both of them are contributing to growth in this area.
Fantastic. Good insight there because it is a growing space. It's as popular. Most people when they think of alternatives or private markets, it's usually private real estate or private equity. But lately, over the past couple of years, it's really been driven by private credit. You see it in the headlines quite a bit. So great insight there. You talked about money and the demand for private credit. Do you think is there too much money chasing too few deals in private credit? I see a lot of concerns about that. Maybe the deals are drying up, but the money's still there. Is that concern warranted, or is it, kind of too much is made of it?
Well, the most straightforward way to describe this, excuse me, is in valuations or relative valuations. And so if we think as an example, equities, and is the equities market overbought or is it too expensive? Well, it's hard to compare. The best way to compare is through a relative measure, such as price to earnings. What is
Yeah.
the price of an individual stock or the entire company relative to the earnings that is generated, earnings per share for that particular single share or for the company, right? And so PE is a common metric. And in the credit space, that comparable metric is yield, right? Where is the yield? Or in the case of private credit, which most of it is floating rate,
Yeah.
is the spread. So what is the spread or the yield above a risk-free rate or the defined benchmark for that particular instrument or security. So if spreads were very narrow or tight in
Yeah.
that the yield that they pay is a small increment above the risk-free rate, that would mean that there is significant yield chasing or significant capital purchasing those opportunities and compressing that spread or yield.
Okay.
And we're not really seeing that. That really hasn't occurred in credit markets. Yes, they have moved down incrementally, but nothing really to levels of concern or to for investors to say, oh, this used to generate X percent and now
Yeah.
it's 3 or 4 points lower. On the broadly syndicated side, or on the side where the loans are too large for a single sponsor to hold and multiple owners hold them, or even on the structured credit side, spreads have also moderated, but we're still seeing significant yield generation. And
Hmm.
so nothing concerning on the spread side. The flip side is investor offerings, right? How many private credit interval funds are out there or are coming to market? And so if we look at SEC registrations, the SEC publishes a whole host of documentation for individual funds and also what's coming out to market. And so if we look at effective registrations and pending registrations, there's a total, as of last quarter, there's a total of 54 funds that have been registered or pending registration. But 30 of those, over half of the 54,
Yeah.
are debt and fixed income funds. So that category in and of itself is larger than all the other categories
Yeah.
combined: equities, real estate, infrastructure, hybrids. So there is significant impulse or
Mhm.
impetus on the sponsor side to generate these offerings. Now it's hard to know which ones of these are private credit. We could
Okay.
look at the names and you could potentially parse out which ones will
Yeah.
focus or have a significant allocation to private credit or not. But it's a safe bet to say that a good proportion of them are going to be participating at least partially in that space.
Mm.
But at the end of the day, not all of them will be successful, right? First, you need to raise investor capital to then take that capital and go purchase uh, private credit. And so,
Yeah.
from the market side, it's not concerning. There's a lot of people that want to come in the pool, but not all of them will be able to successfully participate in the market.
Yeah. Fantastic. You know, I have a lot of conversations on the fixed income side, just public fixed income. And, a lot of the guests and my conversations talk about, there's a lot of opportunity in fixed income, and the state of fixed income markets it's pretty positive right now. Yields are attractive. We've got attractive real yields now after, yields being lowered, very low or very narrow. Does that align with your view on private credit too? That there's a lot of opportunities there in private credit. You talked about just briefly how the yield spreads haven't really compressed much. Still a lot of opportunities in private credit like there is in the public space.
Yes, we do, and for a variety of reasons. Number one, probably in our view, the first one is the uncertainty that we're seeing around interest rates, both on the short end of the curve and around the 10-year term. One characteristic of private credit and broadly syndicated credit is that it's floating rate. And so that has particular appeal today because if interest rates stay high, well, you continue to enjoy higher yields. If interest rates happen to go up, your price or the price of your loan isn't going to be adversely impacted by that relationship that exists on the bond side, right? Where if yields go up, the bond price goes down. And so yields go up, you receive yet even more income.
Yep.
Now, of course, if interest rates come down, you do receive less income, but the Fed has communicated time and time again, has drilled it into investors' minds that they plan to slowly decrease interest rates over time and be gradual. So there's an opportunity here to continue enjoying higher yields for an extended period of time. Well, at the
Mhm.
same time, the 10-year continues to see some volatility at the beginning of the year. In the first quarter, we saw significant volatility. Now we're starting to see some compression. That type of volatility hurts traditional fixed income for the reasons I just mentioned. And private credit is more resistant to that because of the floating rate nature. Now, secondly, is the collateral backing. Now, there were a lot of lessons that were learned by market participants after the global financial crisis. Unfortunately, or fortunately, some of them were pretty basic, like don't make zero down loans to real estate investors or don't give out loans to unemployed individuals.
Yeah.
But more importantly, though, there's both in real estate and in corporate lending, we're seeing much more robust documentation and collateral backing, and that exists to protect lenders in the case of a default. So private credit and senior loans tend to have the highest priority in the capital stack of a company, even higher than bond investors. And that position in the capital stack is also backed by collateral. And so, once again, in the off chance that there is a default or there's an economic slowdown, and the default rate ticks up, and some
Mhm.
of these loans aren't able to be serviced by the underlying borrowers, there's that additional protection that is offered to investors. So for those couple of reasons, we think that there is great opportunities to explore private credit, especially because it's also a burgeoning space. So there's opportunity
Yeah.
for active management there as well. If a market is mature and it's established, it's harder to outperform. but if it's in the first few years of its growth trajectory, you're able to find some great opportunities for outperformance.
No, really good point because we often talk about that, where can you find alpha? In some spaces, it's hard to find alpha right now, especially on the equity side over the past couple of years when select few names or sectors or styles drive markets, right? And so I'm glad you made a good point about private credit and the potential there for outperformance and inefficiencies. I'm also glad you brought up, private credit. They're not as sensitive to rate movement, or the price of a private credit issuance isn't as sensitive to price because it's a floating rate security. So would you say it's a potentially a good hedge to duration then, potentially, since, duration's probably pretty low?
Yes, that's exactly right. And so probably more so than a hedge is that it's not a significant risk factor to duration, right? So it's one less risk to worry about is, oh, what are interest rates going to do? And will my portfolio be protected? Because your portfolio will adjust to the prevailing
Mhm.
interest rate market.
Yeah, good point. Because with fixed income, equity it's not simple, but compared to fixed income, when you have all the credit risk, duration risk, there's so many moving factors there. Private credit, it is, or credit, I should say. It's nice that you can kind of remove one um, from the wall of worry or the wall of risk that you have to consider. What areas of private credit does your team find attractive right now?
Well, private credit means probably means a lot of things to a lot of different
Yeah.
people, but in our view, we take a more defining or a broadly defined view in which it means direct lending or a loan issued to a single lender and held by a single borrower, or more broadly syndicated loans, in that a loan is large enough where it's going to
Yeah.
be held by multiple lenders. And at Bluerock, we believe that the syndicated loan space offers a few more opportunities for investors for a variety of reasons. The first is that the companies or the borrowers are larger. And so these are large corporate borrowers that oftentimes are even brand or household names, brands that are recognized by individual investors. And so there's this established, or there's a mature sense of the company, because it's established, it is uh, less risky than a smaller company
Yeah.
that is looking for credit for a continued growth trajectory. So in other words, if you think of these large and established borrowers, they've been in operation for decades and in many cases. And so there's a lower risk of default if they've already been navigating ups and downs of economic cycles versus potentially a newer family owned or private equity
Yeah.
backed type of company. The second is diversification. Because companies in broadly syndicated loans are issued to companies across different industries, we can more effectively diversify across practically all industries. Whereas private credit, if you look at the less liquid or the smaller side of the market capitalization spectrum, they tend to be more concentrated in technology and healthcare, but certainly a lot of concentration in technology.
Yeah.
But the thirdly is price transparency and liquidity. Because these loans are so large, and because any single loan will be owned by multiple lenders, the broadly syndicated loan space is actually fairly liquid. And
Okay.
so there's a robust secondary market that exists for trading into and out of some of these loans. And that offers two specific advantages in and of itself. Number one, price transparency. You know the value of what you hold because there is trading going on. And secondly is opportunities for active management. And that's, in our view, the most important factor, because yes, you could acquire a loan from a small company and you hold the entirety of that loan, but you don't know how much it's worth because nobody else holds it. You hold a very unique security and you won't know until you sell it. And number two, if you change your outlook on it, it's going to be very difficult to sell. And so that presents an opportunity of you hold it until it matures or you hold it until it defaults. Whereas in a more liquid market, you're able to acquire loans at a discount, potentially significant discount, if the market thinks that uh, higher it has a higher likelihood of default, but you see robustness within it, and you're able to buy it at a discount.
Okay.
Inversely, if you think a loan that you hold may struggle in the future, but the market is pricing it at an attractive level, you're able to sell it and sell it into the market and put that capital to work in other areas. So that's why we partner with a sub-advisor that knows this space very well and has worked in this space for multiple decades because of the opportunities for active management.
Yeah, interesting. You kind of just brought it up a little bit here too, but let's compare private credit and public credit and the impact that it has on, investment portfolios. You know, when I'm a financial advisor, is there something where maybe I should lean more on the private side versus public side when building an investment portfolio? Do they kind of provide the same characteristics? Can you maybe compare the two when it comes to investment portfolios?
Yeah, so as I mentioned earlier, one of the biggest advantages is that private credit tends to have lower volatility. And so from a financial advisor perspective, that benefit certainly benefits the portfolio, but it also benefits the relationship between the advisor and the client because volatility generates stress and it generates more difficult conversations with the client. Has the opportunity to generate higher income, as I mentioned earlier as well. But probably the more nuanced point is that private credit tends to have low correlation to both equities and to public credit, right?
Okay.
So a very simple example is the performance of public fixed income, or call it true fixed income that is fixed rate, and its performance over the last 2 to 3 years in this rate rising environment, and then in this volatile interest rate environment, public fixed income has underperformed, whereas private credit, as measured by a couple of indexes or broadly syndicated loans, have significantly outperformed. So you have the opportunity to diversify both principal components of your portfolio, the equity side and the traditional fixed income side, with private credit because of its low correlation.
Fantastic. Good insight there. I'm glad you brought that up about low correlation because to be, Miguel, at the beginning, I thought, whether it's private or public, the correlation might be the same between those two in equities, but like you said, it's not. So, good point there. Um, what should financial advisors consider when incorporating private credit into investment portfolio? Obviously, I mean, it's semi-liquid, right? But it's still more liquid than, private equity or something like that. But are there some primary considerations when financial advisors are thinking about adding it to their clients' portfolios?
Yes, so I think it's not only for private credit, but for any investment, it's very important for investors and their advisors to have a full understanding of what they're investing in. And so the prospectus is there for a reason, and investors should inform themselves of what they hold in their portfolio because ultimately their portfolio, their capital is what they will benefit from or potentially put at risk at and be challenged by if there is an obstacle or underperformance. So that understanding, I think, is most important for investors. Fully understanding that not all investors have that background, but everyone can certainly take a stab and learn more by reading the materials and asking questions to your advisors and to the sponsor as well. Secondly, is the other some of the other aspects that should be considered is the pricing or the valuations, especially in middle market or true private credit. And so, as I mentioned earlier, if something is private and it doesn't trade on markets, or if the volatility is uniquely low, well, what is the value? How is that being valued? What is the price of that security? And the world changes and it evolves, but the funds continue to perform. I think that should invite questions from investors as well as advisors and consider it into place it into consideration when they're looking to add that into their portfolios, because it might be attractive to see a very steady stream of returns, but it's also important to ask why that steady stream of returns was generated. On
Mm-hmm.
the fund side, specific is investor liquidity. So make sure you understand the terms of how the particular fund will offer liquidity, in what situations it might offer less liquidity. And keep in mind that the likelier you are to be challenged and require liquidity, the likelier it is that other individuals will also require liquidity. So in other words,
Yeah.
in a market downturn, in a recession, yes, your portfolio may be down and you may want to move to cash, or maybe you do need liquidity, but other individuals are likely to be challenged as well, and they will want liquidity. So in those situations, make sure you understand, will your fund be able to meet your entire requirement for capital, or is there a potential there for proration as well? And lastly, briefly, is income. Look at the income generation, but also look at how it's generated. Many funds, if they're challenged, will generate income by not necessarily receiving cash, but by receiving what's called payment in kind. And so make sure you understand, which essentially means that the fund or the sponsor is receiving more private credit instead of receiving cash. So they have a loan, instead of receiving, call it 9% payment on that loan, they're being paid with 9% of more loans, not quite the capital that can be paid out as income. So make sure that both you and your financial advisor understand if that is the case in that particular investment, or if it is all truly cash.
Miguel, fantastic insight. Love that you brought up, education first, right? Making sure you really understand what you're investing in. Not saying that, private equity or interval fund will blow up, but I'm a firm believer in having that conversation. If something bad does happen, that conversation with your client is a lot easier if you do the work up front and really educate them on what they're investing in, and so they know what they're investing in, versus not educating, have something go bad, have something blow up, and then trying to educate them on why. And so I'm big on
Exactly.
education here on the show and information. So I'm really glad you brought that up. Miguel, thank you so much for coming on the show. After our first conversation, a year ago or so, I knew this one was going to be really good too. A lot of great insight, and you brought it, a ton of great insight. Where can our audience get more information about Bluerock Capital Markets?
Yeah, so your audience can go to bluerock.com, our main website that has not only our investment products, but a whole host of educational information. If we end on that note, we have what's called the Blue Rock Library, where we discuss private credit and other asset classes as well. That is agnostic to any investments. It's just
Okay.
purely focused on education. We're also on LinkedIn if you look us up under Blue Rock.
Miguel. Thank you so much. Great conversation. And thank you, everyone, for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our other episodes on the Zephyr YouTube channel and Spotify. Please be sure to like, subscribe, and give us a follow on LinkedIn. Thank you and have a great rest of your week.